All right. So, hi everyone. I hope you can hear me clear and right. My name is Sanjog, and I am basically an entrepreneur based out of Bhubaneswar, Cuttack, and I have a small vegetable processing company, food and vegetable processing company called Marty Farms. Today, I'm here to introduce our guest speaker and have a conversation with him. His name is Mr. Mahesh Jakhotia, and he's basically the co-founder of Bijak, which is India's online platform for agriculture, customer presence, all the states of India now.
Sanjog, your voice is breaking a little.
Yeah.
Yeah, your voice is breaking in between. Yeah.
Am I audible now?
Yeah, it's better. Yes.
Yeah. So, guys, I was talking about Mahesh, who is basically with Bijak. He's one of the co-founders, and Bijak, as some of you will know, is this startup that started up not too long ago, and they've had a very interesting growth trajectory, primarily an online platform for agricultural trading, and they've successfully raised, investment from a number of investors, including Sequoia and Overvalued, which many of you will know. And before that, Mahesh was there with a couple of other. He had a couple of online ventures, including Revolt Protocol. He was part of that. And before that, he had a very interesting, before his entrepreneurial career, that is. He was in investment banking space, and he was with Investee Capital, where he has been, involved in successfully fundraising over almost $1 billion USD for India's marquee companies. He's a BITS Pilani graduate and also Young India Fellow, where I got. And one of the most interesting things about Mahesh that I like is he's a fitness enthusiast. I would say he's a pro-fitness enthusiast, and there's a certain amount of discipline that I've seen him, undertake, over his period of the last decade, 1 decade that he has been working. I would like to also probably touch on that when, once we are done discussing the more things that are closer to the topic. So, Mahesh, the floor is open to you. Please go ahead. I believe my voice is not reaching out well for some reason. Okay? So, just go ahead and start with your thing.
I think there is some issue at the Mahesh's end, so he's just joining in a bit. So there is, I think, some network issue. So he has just messaged me. So
right, I can see the messages. I think your voice is coming out quite clearly. The problem is at our end for some reason.
Yeah, I think if the network is better, or if you can come closer to the mic, if that can work.
Am I better audible now?
Your voice is getting better, but yeah, we can try. Yeah, we can try from now.
So just, if possible, guys, let me know if you want me to do the introduction again, or we'll just wait for Mahesh once he is back, and we'll continue from there.
Yes, so let's, I think, wait for Mahesh, and then we can start again.
That's great, Gary. So, guys, if you can hear me, that is.
Yeah, so Mahesh is back.
Observing. Oh, great. Welcome back, Mahesh.
Hey, thanks a lot, Sanjog. Sorry,
Mahesh, before you begin, I would just like to say to everyone present that if anyone has questions while Mahesh speaks, just type them in the chat box, and we will give the floor to you. So it's just that we want to know who's asking the question. So do type it in the chat box if possible. And once after Mahesh is done speaking, then we will open the himself.
Sure. All right. Thanks, Sanjog. Thanks for the introduction. So, as Sanjog must have said, Bijak is a B2B marketplace that connects the suppliers and the buyers in the agri ecosystem. We raised our seed round back in September from Sequoia Capital Search Program, Media Network, Omnimo Partners. We raised a Series A recently, about $12 million from RTP Global, Sequoia Capital, Omidyar, and VIX investors. So it's been a very interesting journey. I happened to see a bunch of questions which you had posted earlier prior to the call. If it's okay, I'll just pull up a sheet and maybe walk through the whole journey, like how do you position and brand yourself for a kind of fundraising journey. And this journey might be very applicable if you meet, if it's more applicable for like authentic investors or someone, credible investors. It might not work for some vanity investors. Let's say a lot of people call themselves, let's say, startup gurus or, startup mentors. So it's more focused towards investors who, have really care about the startups and who really care about. Just let me maybe pull up a sheet. Just one second. Hey Gaurav, can I just
yeah, you want to
enable my screen
yeah,
sharing?
sure, yes.
Yeah. All right. So if I look at the whole startup journey on, let's say, the day zero, you have one sec, sorry. You are a founder. Let's say day one, you have the idea, you have the, let's say, product or a business model, something you're working on. Day two, you are trying to build a culture in the team. So a lot of my learnings are actually also derived from, my startup journey, as well as a lot of, I have happened to, learn a lot from other mentors from the ecosystem, from our investors, from Sequoia Capital, from other investors, from like say Vijay Shekhar Sharma from Paytm, or some of the more successful investors like Gaurav Munjal from An Academy, etc. So for how do you position yourself as a founder that can attract the best of the investors, and also that could actually make your company much more valuable, that can take you to a more successful path. So I think first step would be to be obviously very customer obsession. Being obsessed about your venture. You have to be always obsessed. Michael Moritz, was one of the founders of Sequoia Capital. When he was traveling with Bill Gates, while dropping him back to the airport, he asked Bill Gates that why doesn't he have a radio port in his car, etc. So Bill Gates said that he doesn't have a radio slot because he wants to focus on Microsoft throughout his journey. Even while traveling back and forth to work and etc. Of course, so it's always about being very obsessed about the idea. Being an entrepreneur is like there's no office hours. It's like a full-time journey. It's like a mission which takes almost sometimes people's lifetime goals in building a successful company. Microsoft was built in a period of span of 22 years. Google has also taken more than 15 to 20 years to build a very credible company. So being obsession 101 is very important. Obviously, second thing could be, growing yourself. Maybe if, for example, if you try to grow yourself on a 1% on a daily basis, it's like phenomenal. Always try to improve yourself on a daily basis. It could be learning something new, either on the technology stuff, or either it could be something on the product stuff. And you can see that even if, let's say, if you want to calculate in a span of 5 years, you can maybe, increase all the way to, if you start increasing 1% every day on day, the compounding effect makes you almost 77 million times bigger than what you are today. So this is also something what Deependra from Zomato has suggested, that as a founder you should always focus on, one second, sorry, one second. This is already made. Yeah, just let me here. So I have written some of the points here. Are you able to see my screen as such?
Yeah. We can see this.
Yeah. Cool. Yeah. So let me focus on some of the points I listed down. Yeah. So the third is being switched on. Have like sometimes free time every day, so that you can focus on new venture ideas on a daily basis. A lot of adjacent ideas crop up near your venture, and you can start focusing on those. This is something which I learned, Sequoia obsesses on this particular front, which is focusing on something around LTV plus growth, which is, focus on learning, always be available for a learning, trust your, team members, trust your founders, and be in a kind of a trusting environment. Be vulnerable. Sometimes some things you don't know, sometimes you're not to be authentic. Be ready to, know the true north of yourself. What do you know and what you don't know? And always have the gratitude that you got this opportunity to, build a venture, build a successful venture, etc. So yeah, let's move to day one. I hope I'm, yeah. So from an idea perspective, once you want to start some idea, there are various ways, right? You can build a venture. One is either you can go after the market share. You can capture the market share from the existing segment, which implies. So is this? Are you able to see this Excel which has day one written on it?
Yeah, right.
Yes.
Two Excel. Yeah, good. Great. So a lot of these e-commerce companies, I mean, what they have done is they captured the existing market share from, let's say, the retailers or the offline. If you're building a venture, either you're operating in one of these three areas. Either you're trying to capture someone's market share, or you're trying to create a new market, or you're going for, better margin. Your business model has some proprietary insights which helps you go build more margin expansion. For example, in the new market category, KIIT or the KIIT company, right? The mass people of India were never so obsessed about fitness and all these things, right? This was the KIIT became, started this new market, started this fitness craze among all these, multiple masses of India. If you look at a company like, if you look at margin expansion and consider an example such as Country Delight, is able to gather better margins because of their proprietary distribution system, focusing directly to the consumers. So I guess you also need to understand, where does your company fall? There could be other ways to look at your company, which could be either focusing on something like, whether is it a clone or is it a mutant? Is something like you are copying Uber for Indonesia, which is in the case of Grab, or you're building something like a mutant, something very unique, similar problem, but with a very unique solution, which is Gojek has applied the Uber's problem, which is solving the transportation needs in the form of a two-wheeler kind of structure. And then once you have you understand where your company falls into, what kind of, once you have the founder mentality set up and have this idea set up, you need to build a good culture of team, build a culture, it should be, you should have something unique about your company's culture, some values because of which you can attract other people and also hire people with similar kind of culture. There should be that kind of camaraderie in the team, in the kind of emotional connect with various team members. That's something which will, drive you to, attract the co-founders or bring the best out of your team members. Have this kind of culture in the team and keep on hiring similar people, keep on getting co-founders with similar kind of customers. Then if you progress to day 3, you get a customer, your customer loves your product. After day 4, customer is delighted. He's getting on your platform, you know, without any incentivization. Maybe sometimes you also need to incentivize, like the case Paytm had done. They did a lot of free charge, but the elasticity was very less. Even if they stopped their cash back, consumers still found a use case. So always see this, elasticity of whether your consumers would remain in your platform irrespective of the cashbacks given, etc. But the moat is the customer should keep on coming on your platform, or you should transact or should find it usable, and should come on your platform without any incentivization. So once you have achieved these factors, the MVP and the customers loving your product, then the next step is go towards approaching investors. Once you have reached this particular stage, from the investor aspect, now, I see that a lot of people had asked, approaching angels versus approaching seed funds or Series A, right? I'll talk about these. I'll talk about more on the seed and Series A kind of, investors. Angels is more on the basis of faith and trust. It's more like very ambiguous. Like if you have a very good rapport with a certain angel, it's kind of there's no science behind the kind of angel investing. But from a seed and Series A, right? I'll just focus on some of the mistakes which a lot of founders keep on doing, right? I see like when you have approached certain investor, he has a very limited bandwidth. He's focusing on, let's say, building, helping out his portfolio companies, and then trying to evaluate the new opportunities, and also focus on his existing deals that are going on, close them. So when you have spoken to certain investors, have that certain confidence, have that, don't follow up multiple times, because that might sound kind of needy, that might sound as a desperate in this, not just in investing field, but if you look at the whole world from from everywhere, right? The more you seem desperate, the more people may not like that particular aspect. Unless you are liked by a lot of other people, they then feel the fear of missing out. Hey, he seems to be very hot stuff. I mean, I know this is a very bad way to to actually evaluate a venture or evaluate a person, but that's how the world works. That's how the world psychology works. The guy which has the maybe the person which has most number of followers, or people admire that particular person because what other people think of him. They think very high about him. So this is one thing, that when you are trying to approach investors, when you're trying to follow up, right, be very confident, be very passionate. You need to be extremely passionate, showing that irrespective of your capital, I'm going to build the business. Whether you be or not, I'll raise it from someone else. I'm pretty sure that my business model is so strong that confidence needs to be come out from your from the overall interaction, etc. Especially in seed and Series A side, you shouldn't focus much on making your deck as jazzier, as beautiful as possible, because then it shows that you are trying to replicate the lack of the moat of the business, or the lack of metrics in the form of beautiful designs and everything. In Series A or later rounds, I understand maybe the whole presentation and all that seems very important, but in initial stages, the more fancier it is, it just shows that these are all vanity metrics. That you shouldn't be spending time on on these particular things. And trust is extremely important. For example, when Paytm, Bijak VSS walked into the room of Jack Ma, one of the very primary reasons why Jack Ma invested in VSS was that he was Bijak Sharma is the Goldman Sachs managing director was sitting beside him. So there was this particular trust that, hey, if the Goldman Sachs managing director is introducing me to certain founder, then it must be a credible founder. That was how the first investment from the Chinese conglomerate e-commerce company got in Paytm. So always have investors should feel very trustful about you. They should see that honesty. They should see that passionate. When you're, talking about your venture, be as passionate as possible. You should, intuitively, like intentionally, inherently, you should be very passionate from internally, and that should project outside. If you're not passionate about your venture, about your idea, about your business, then it doesn't show up in an authentic way on the outside basis. So yeah, and some of the very finer dynamics, like how do you posture and all these things are very important. You just can't go and be there. You shouldn't have such kind of like submissive posture wherein trying to just open up and show off the tech and everything. It should be more like, I'm giving you a favor to invest in my company. That's the kind of maybe that's kind of very subtle messaging shift up that, hey, if you invest in me, it's fine, but if not, even I have other places to get capital from. Let me focus. Once you have you have approached multiple investors across seed and series A. Also, before approaching, just make sure that test your pitch, test your presentation, test your whole methodology with some of the lower prioritized investors. Test the water, see what's the feedback. Are you at the right time here? Before approaching the right investors, just go and experiment with some of the low hanging other third priority or the second priority investor, so that you get the proper feedback. So once you have once you start getting the serious interest, right? Now closure is very important. You have the interest, investors are confident about you, but still they might not close the deal, because for them, the later the deal happens, the more clarity they might get about the business, right? So your goal is to make them close and invest in your company as right. To make that happen, if they feel that they are losing you to someone else, then they might want to invest you immediately. So your goal is to close as soon as you get a serious interest. Your goal is to take it to the term sheet and take it to the end closure level. So at this point of time, also focus on a lot of doubling down your metrics. If you have that virality built in, that MVP, and if you believe that more marketing dollars could get you more customers, or more salesperson can get you more customers, focus on those particular aspects, because this is a time when the investors are closely monitoring a lot of your things. They believe in the idea, they believe in the market. Now they are trying to evaluate your metrics. So, and they should be like, minimum of their benchmark is, let's say, 30 to 40% minimum month-on-month growth rate should be on your radar. There are various hacks, like some of you might be fortunate to have a very good MVP stage, right, wherein the virality is pretty high that you don't have to do anything. The growth rate is being kept in. In some cases, the variety is kept in, but there is some friction from the newer customers. So in those cases, you can use some of the hacks. For example, one of the largest B2B companies, they started a flat delivery, Udaan, which is one of the fastest unicorns. They did a flat delivery fee in the transaction, which is they started charging somewhere around 100 to 200 rupees per transaction. With a flat delivery fee, customers realize that, irrespective of whatever quantity I send, my delivery fee is going to be 100. So let me send larger quantity size. So their AOV increased, their average order value increased, and that eventually helped them, increase their overall top line as such. I know a lot of logistics companies, on the lines of Freevigo, Delivery, or Blackbird, they had tied up a very large strategic deals with petrol pump companies, wherein they started, they partnered with the petrol pump companies at one hand, and offered these petrol cards to all their customers and gave them around 5% cash back on these petrol cards. They got those incentives from the petrol companies, from the fuel companies, and then they passed all the benefits to the customers. So this was then some other metrics through which a lot of these drivers ended up joining the platform. So you also need to see if there are any inorganic hacks that can help you double down your metrics during this particular phase. And this is also the time when I'll try to be as authentic as possible, but but of course I'll try to filter out as much as possible. It's also the time to crisscross and approach other investors, stating them the seriousness of an existing investor. As long as you don't have anything sign of an exclusivity kind of thing, you should definitely try your chances with other investors, because unless there is an urgency or tension with your primary investor who wants to put in money, they won't. It's very difficult for them to come to a closure stage. So you need to bring up that urgency. You need to show that urgency. It's always good to have more options. So yeah, this is there. And towards, once you have closed a deal, once you have a term sheet, once you have, let's say, almost on the final stage of certain investor, try to get in more co-investors to join your platform. Strategics or the co-investors, which your primary or lead investor would be fine having them along. So you can, all the way from approaching the investors to getting to a serious stage, to the closure stage, you can try to do these various things. Also, I see a lot of entrepreneurs asking us, what's the valuation? What's the right metric of valuation? In angels, seed, series A, valuation is just a game of art. Given all these stakeholders would be able to make money when you eventually become extremely big in Series D, Series A stage, right? It's valuation. There's not much science behind it. Like, I come from investment banking. I have done various rounds of valuation, from discounting cash flow or the leverage buyouts model or the merger acquisition model. There are hundreds of multiple models. Those work in extremely large, profitable, free cash flow mechanics companies. But in early stages, it's more about how much, what's your interest, how much competition do you have for investors approaching you, or it's basically how much power do you have in your hand. That's what your valuation is. And whenever investors ask that, how much are you trying to value, you can just answer them that, hey, I mean, you are the investors, you should let us know what should be the valuation, what should be the pre-money or post-money of my particular venture. And dealing with rejection, let's say, there might be a lot of ways, because if you deal with rejection, right, they might say something like, it's too early, or it could be, there could be multiple reasons, or it's not profitable, or they are looking for revenue metrics, etc. Investors might give a lot of reasons for rejection, but you don't know the actual truth. For example, like in the Indian societies, sometimes they're very subtle way of rejecting. I mean, it's a very controversial topic, but some subtle way of rejecting someone's partner. Some of the guys say that, hey, horoscope was not matching. It's just a very subtle way of saying that, hey, there were some other reasons, but I'm just making things simpler. I just don't want to have that difficult conversation. Sometimes investors might, instead of being authentic, saying that, hey, I'm not actually looking to invest, I'm just trying to update my knowledge base, hey, but I don't have capital. Instead of trying to state the actual reasons, they might make up some other reasons to mark the rejection. So you shouldn't really, unless you are very sure that this is the rejection reason, you shouldn't really take it in a very serious way. Coming in the current scenario, COVID scenario. So all these, having investors reach out and all these things make a lot of sense in the good times. Right now, in the COVID scenario, our personal, having seen all the past financial distresses from 2008 to 2015, etc., right? We have seen that. Personally, see that investment, interest starts after maybe a few quarters or 6 to 9 months down the line. The investor interest evolves in a much larger way. Back in 2009, post the financial crisis, the investor interest was at the maximum. 2015 end was again at the peak, back at the peak. Now, of course, this current scenario is extremely, it's much worse than the previous scenario. But what I understand is, given that the whole $1 trillion stimulus package in US is reserved for, let's say, the HNIs or the sovereign wealth funds, etc., they are aggressively looking to invest. So US might not be the good option to invest. They are not going to go after China. India is like a very sure, very good market for them to invest. If international investors start investing in the Indian market, then the Indian VCs feel the competition, feel the heat, and they also start putting money, and that trickles down to the lower ends of the strata, across the Indian investment, etc. So I think I'm very optimistic about the investment market in the coming 6 to 9 months. It's going to be much better. So your job is right now to peak yourself, to build as much as possible, so that you are ready when the time comes in. So something else that I could focus on. Yeah, I guess that's from my end. Case.
Hey. Hello, Mahesh.
Yeah. Hi.
Yeah. So, thank you for being so candid and touch upon the sort of, the underlying psychological processes going on in the subconscious behind an investor-investee interaction. We will have a lot of questions, I hope, but a couple of questions that came to my mind is when I was looking at your spreadsheet that you made. So you have this process that you outlined, right? This origin story, the founders come together. There's the idea creation or the business model.
Sanjog, your voice is a little shaky in between. I mean, I think due to network. So if you could try.
Maybe you can switch off the video, I guess. Maybe
yes,
that will give more bandwidth.
Just give me a moment while I try to switch off the video here and log in from the other.
Right. Yeah.
Am I audible now?
Yes. You're audible.
Yes, you're audible.
So one of the questions that I had for you was that in the process that you showed between starting the startup to the creation of the idea of the product, and then creating a team around it, and developing a product and gaining some traction, and then you start thinking of raising investment. But if you look at Bijak's journey, then because of the search program at Sahu, you sort of bypassed some of the stages, right? You had a small team to go with. You were a bunch of co-founders, but your platform was not really, it hadn't evolved to the point that it is now. It was, conceptual at that point. And yet, so is that an exceptional development, or is that increasingly becoming the norm? Is that increasingly becoming a possibility for startups?
Right. Yeah. So in our case also, right? We came all together. We came in April 2019, and May 19 to August 19, right? We were doing. It was a pilot kind of program, right? Our initial product was kind of was more towards the bookkeeping kind of product, which helped all these agriculture traders, put in their trades, try to see all the ledgers in a much more seamless way, in a much more smoother way than what they had used to do it on a pen and paper. But that was the initial business model. Now it's more on the complete. Since October, we pivoted to a different model, which is on a discovery as well as a marketplace. People enabling e-commerce transactions happening on the platform. But during that particular phase, we did have a good traction at that point of time. We were growing very significantly at that point of time before. While talking to investors, but before maybe in May or June, we did approach for some of the investors before we had traction to just get a sense of more what they think and etc. And the messaging was clear. They need to see the results of the MVP and then they can take a call. So fortunately, we had a very good MVP and the results were very attractive. We did this in the region of UP as well as Bihar, and that helped us. Having said that, are entrepreneurs raising capital before reaching the MVP stage? I mean, the second time entrepreneur definitely does. You look at folks from like etc. Payu, Jitendra Gupta, who has started Jupiter. He has raised 25 million. I mean, or if you look at Kunal Shah from Fed, these are like extremely successful entrepreneurs who can raise capital at the early stage, at the idea level, or even or before the idea also sometimes. Yeah? Those exceptions are there. In your cases, yes, you can. If the venture is something in a very different space, for example, one of my friends was building an aluminum fuel cell car, right? The car is going to come out after 3-4 years down the line, 2023, 2024. But there was a lot of prototypes and products done. The revenue hasn't come in, the MVP traction hasn't come. In these type of ventures, you need the capital, and in this type of ventures, it's easy. I mean, you can attract funding maybe before you can actually have those revenue or the traction in place.
Okay. So the other thing is that you also closed during the lockdown. So I'm sure the process for it had begun before the lockdown was declared.
Yeah.
So how was that? That must have been an interesting story.
Yeah. We had like extremely, very good investors who had a lot of trust on us, who never like reneged the deal. They never like went back. Hey, it's COVID situation. We don't want to, but they had the complete faith in the thing. And it's very difficult to find, such kind of like authentic investors who would always back you, despite the downfalls and everything, right? So finding out such investors is extremely important, who believes in the team, who believes in the founders, who believes in the business model, and is fine with the initial ups and downs. But we also try to close the deal as soon as possible. As soon as the lockdown happened, we realized we have to, move things in a much faster way and finish the documentation very soon.
So are you saying that because you've had very short, you raised quite quickly, second round of investment, right? Within a few months. Within that period, did you also have were there a lot of such conversations with investors which led to a breakdown of talks? Like, did you reject a lot of investors, or did a lot of investors reject you?
Yeah, it actually happens. So even while you're raising a fund, right, you want to keep a backup of certain investors who aren't aware that you have some lead investor or some documentation going on or some closure going on, because you never know how things will pan out till the end. Let's say if you're dealing with certain hedge fund based out of US and the US markets have tanked down, they might not be able to invest, although they have the intention, but they do not have the capability to invest in it. So you always have this backup set of investors at every stage who are not aware about your ongoing discussions with existing investors, etc. So that you can use them if things go down south with these set of investors. You can use those kind of investors. And of course, you sometimes have to say no to a lot of investors. There was a time when we couldn't pick up multiple calls from multiple investors. We just realized it's better to go with the faithful and more authentic investors rather than experimenting with new investors.
Right. We have a question from Mr. Gary Christopher. So Gaurav, if you can, Gary, if you want to ask the question, very interesting question, and I think you would like answering it. But would you like to ask yourself, Gary? I don't know if you can hear me.
I'm unmuting you. Yeah, I'm unmuting Gary. Yeah, Gary, you are good now. You can ask your question.
Hi, Gary. So I think Gary is, not or he's not. I'll just read out the question. So basically, what he wants to know, Hi, Gary, are you
Yeah,
there?
hi. Yeah, I'm here.
Yeah,
Fine.
just go ahead with your question yourself.
Hi, and great meeting. So I work on something on the lines of AI, and most investors I meet, they want to know the neural algorithm and the neural structure of it. But what I try to do is I distract them, and I give them something very similar, but then I don't give them the right answer. But then they seem to want to stick to what I consider a secret. So it's like it's like a really common thing. It's a human nature to know the unknown. But how do I overcome this? This actually made me reject a lot of investors. But do I really need to disclose the information?
Right. So guys, this is something very, it's kind of your core of your company, right? It's very IP protected kind of stuff. This is something I think which you can't reveal and which you shouldn't reveal also. What, because you never know, right? I mean, how, let's say, some of the investors might use up, or how it can be copied or transferred to somewhere else. What if you have this algorithm which is able to do, able to get some best output better than the existing solutions or existing status quo of how things work, then you should try to showcase those kind of outcomes. That, hey, my algorithm is able to predict, let's say you have a lending algorithm, and you are able to, based on certain data points, non-financial data points, you are able to predict the score of these certain borrowers. And these borrowers seem to have those kind of outcomes. When you try to lend to them, they really predict those kind of characteristics. So maybe you should focus more on those outcomes, that your algorithm strategically gives better outcomes than any existing solution. Even in our case, like, we have our rating mechanism going on, right? We never, as long as the customer is delighted, as long as the customer is coming multiple times on the platform, he's getting better margins with our high rates. That should be a proof enough to say that yes, algorithm kind of works.
So you gave them sample data to show them the legitimacy of the algorithm, or did you actually show it in real time?
So what were your last two words? Sample, for them sample data? Or
did you actually work it in real time and show them the data? Because you see, the more data we have ensures the success of the output, right? So sample data, in essential, will only give you a very very inaccurate data. So how did you overcome that process?
Right. No, even sample data should be work. You're saying between sample data and the real-time data, what should be more important?
Yeah.
Right. If sample data.
Gary, Mahesh, let me cut in. Gary, what Gary is saying is, he's saying that if you use sample data, then you might come up with very inaccurate predictions, or very inaccurate results, which might not reflect the the real time, or vice versa. So how do you work around that?
Okay. So Gary, if you can get to the real data, if you can open up your algorithm to the market, then nothing like real data, right? But till the time the real data doesn't come up, if you can have a sample and see how the results are panning out, if your algorithm is really good, then even the sample data should, in a kind of controlled environment, should try to give the outcome you are wanting to get. Secondly, also, while disclosing the investors, right, maybe you can just outlay not all the past, but maybe a little bit around what kind of schema or how unique that algorithm is. Instead of completely, showcasing, opening up all your cards, maybe you can just showcase a bit parts of it, which say,
okay.
Yeah.
Well, yeah, that's still the biggest problem, because see, going to market is where I need the investors to invest in me, and that's where it actually breaks. So I've been working on the project for the last 3 years, and by the time I wanted to approach investors, it was somewhere around June last year. And then when I approached them, this is the process that I've been going through. I approached people in the Middle East, I approached people in India, and throughout the entire thing, this has been a to and fro process where I go and they ask for deeper details, company secrets, and then I come back and I say, hey, it's not ready to. I'm not ready to reveal any secrets yet.
I think you should be careful of such kind of investors who are trying to get into a company secret, because you need to go after the branded names as such. There are a lot of these investors who are maybe in the market to trying to extract information, or trying to update their knowledge base.
Yeah.
Or trying to share your information with your competitors. So you need to take that particular call, do a ref check on the investors, what kind of companies have they invested in, what's their image, or what kind of reputation they have in the market. Even these factors are extremely important. Else, you never know, they might be investing in your competitor product and just trying to dig into your information and sharing your information back to them.
I think Gary, if you have if you want to follow up on this, you'll have to take this offline. But we have a couple of other questions.
Yeah, I agree.
So the next one is from Ms. Priyanka Dora, and I'll let her ask the question herself if you can unmute her, Gaurav.
Yeah, Priyanka, you're good to go. You're muted now. You can ask the question. Priyanka?
Yeah, so, hello?
Yeah, hi,
Yeah.
Priyanka.
Yeah, so what I was asking was, I was trying to communicate through many investors and trying to raise the funds. So how to do it basically during this time? I mean, it's not really possible to go through everyone and
during the lockdown?
yes.
Priyanka, I know the process is much more, during the lockdown, the process become much more tougher, which is ideally before the lockdown, maybe you had to approach, let's say, 50 investors. Now you will have to approach 500 investors to get kind of similar kind of responses. It's also finding out like which investors are keen in the current market, and secondly, also see if your company, is there any way for your venture, your product to benefit from the current lockdown situation. If it works, then I'm sure there could be a lot of traction. But if your venture is somewhere which is anti-COVID, which is inversely correlated to the COVID's growth, then it's going to be a very difficult challenge. One of the ways might be to do a lot of mutate your products to come up with something that could benefit from the whole lockdown situation. I know one of my friends who had built a AI stylist for apparel stores, which works with, let's say, Fab India or something, which gives all these in-store salesperson to suggest the stylist decisions to various customers. Now they have moved all the way to kind of a call center model, wherein helping these apparel retail stores to deliver to the home of the customers. They're able to communicate over WhatsApp that what kind of design they would like, and they deliver the products back to the doorstep of these consumers. So they try to mutate. She spent a couple of 2-3 weeks trying to find out which direction, which adjacent territory can she capture, so that she can benefit from the COVID scenario and kind of help her. So it depends if your venture, as a conclusion, if your venture is kind of against the COVID scenario, then it's going to be a challenge. You'll have to do much more hard work. We'll have to approach more number of investors to make things.
Or if there's a possibility, then adapting to the the extraordinary situation might also sort of basically this calls for a pivot. Would you agree?
Indeed. There are every company, like if you multiple examples, you can see that which have pivoted almost hundreds of times. And these are, companies listed on NASDAQ or the unicorns. You read them, they have definitely pivoted multiple times. What Netflix was used to sell on DVDs now sell on HD, online streaming, etc.
Right, right. Well, there's an interesting example that I thought of, Mahesh. My brother, he owns a restaurant, right? So in partnership in Delhi, and it's a fine dining restaurant. There's no way they could have done takeaway, but they also have, had to pivot, and they've taken on this new, concept of luxury catering for, like small luxury indoor events, which allows them to stick to their ideals, which is, in fine dining, but will survive this, the coming months and years. So it might not. This has led to a radical restructuring of their core goals and their vision. But I think extreme situations call for extreme pivots, right?
Indeed, indeed. I guess that's a very beautiful example. Yeah.
Right. So there's one last question that we had, and this has to do with. It's a very specific one. So I don't think there will be anyone better qualified to respond to this here. And the question is it better to be undervalued or overvalued in the first round of funding? And because you said that, there's not much science to, especially in the early stages, because there's so little data to operate with, there's not enough science, into the process of, valuation. So what's better for a startup in that scenario, to be undervalued or overvalued?
It's it's kind of a very controversial situation. See, if you're, it all depends. The two cases, like if either you have the investors who would back you up. There are certain investors who are bold, who would always support you despite the circumstances. If it's such kind of investor, then definitely overvalue. It works in your favor. That even though going forward, you might face some kind of issue or something, they won't down round the your venture, etc. If the investor has a reputation or based on their past behavior or past portfolio companies have not been very fair to the company, are very strict or very rigid, you can also know from how they structure the shareholding agreements and everything, how stronger their terms are going to be. If those are the kind of investors, then you have to be very careful because once they don't see in the coming rounds, they don't see a very significant uptick, they might not feel happy and might act in some worse way. So I think it all depends on what kind of investors you have, and it's always in early stages. It's fine. It's go for as much as possible. I know sort of my cohort members also who had term sheet, let's say for 7 million valuation, then they got a term sheet from another investor for 14 million valuation, and they kind of got this into competition because in early stages, right, all these are like smaller numbers anyway. From as long as it's less than a 2-digit number, it's fine. In early stages, 2-digit number is fine because all these investors start earning money once you reach a 3-digit kind of valuation. So it's like from a returns perspective, either it's 0 or 1. If you become successful, they'll make money. If you don't, then they right. Anyway won't make money.
Right.
There's no mid path.
Right. So there's one more question from Gary. So Gaurav, if you keep him.
No, don't go via merchant banker. No, merchant banker valuation and can it be initially with a normal. Don't go via investment bankers. There are a lot of, especially in early stages, it just shows that hey, this particular person has tried all his hands on his own. He's not able to raise funds, so he's appointed some intermediary to run that process.
Okay.
Sorry, Gary. Yeah, go on.
No, go on. You were saying what you
were. So I guess your question was how effective is a merchant banker valuation, and can we pitch initially with a normal investment banker valuation, as merchant bankers are quite pricey. Achha, you are saying from a valuation perspective?
Yeah.
I know merchant bankers who have worked with unicorns, who have worked with Flipkart and everything. You just have to quote them what valuation you need, and they are able to come up with that valuation. So
yeah,
even the investors understand that those valuations not work. No one, it's like no one takes
them serious. Okay.
It's a regulatory requirement on ROC as well as some FDI and RBI requirements. So you need to get a merchant valuation. You just need to state him a number that, hey, my venture is valued at 80 million. Can you get me 80 million valuation? Yeah.
So that's really not considered by the investors.
Yeah, it's not real. It's not taken seriously by genuine investors. They will never consider any much
So,
amount of valuation.
so Mahesh, I have a question here. So, what valuation base do they accept? I mean, for investors, do they do their own valuation, internal valuation for that?
It's, I mean, there are, I mean, as I said, there's no maths behind it. It's basically how much leverage, how much can you, how much power do you have in your hand? Because mostly in early stages, you might be either, let's say, uh, you might be pre-revenue, or even if you have revenue, you might not have profitability, or even if you have profitability, it's still, accounting that growth, that upcoming growth is very difficult to incorporate in such early stage of venture. Uh, but there is some typical examples which other VC funds might use just to reconcile the numbers would be they would look at valuation multiples. Like let's say if you are a food delivery business, they'll try to see what are the other food delivery businesses, what kind of multiples
Right.
have they gotten. If it's let's say a bookkeeping app, they'll see what's the GMV flowing through you and what was the other comparables in the market. Uh, Maybe those are they would try to look what the competition has to say, what are the other competitor multiples, or the other way is a similar venture in your space got X valuation, so you can command that valuation. You say to the investor that a similar company like us has received X million dollars valuation, so even we deserve such kind of valuation.
Right.
It's like I've seen ventures valuation investors increasing the valuation all the way from X to 4x, X to 5x because they were able to get term sheets from other investors, or they were not happy. The entrepreneurs were not happy with the given valuation. So there is no such math or science. It all depends how much like power do they have to how much power do you have in your hand to to play around with it.
Okay. Okay. So, so if we were to just get a valuation based on the variables that are actually necessary, that's good enough.
Sorry, what was your question, Gary? What were you saying?
So, if we were to just get a valuation properly done with including all the necessary variables that are agreed upon by a number of investors, the evaluation is good enough.
If you're valuing yourself basis n number of variables,
the right type of variables to add on to the valuation. Like
see, right. So, for example, if you're in the utility space, in the power space, and there is a large, let's say, public company or certain other startups which have kind of similar metrics or a similar business model, let's say, and the output, let's say your pre-revenue, then one of the ways to consider the output is what's the valuation multiple, maybe on the basis of power generated. Let's say a particular company generates 6 megawatts or 6 gigawatts of power, and they are valued at $2 billion. It's a public listed company, right? So you know that for every one gigawatt, you have somewhere around $333 million valuation. Now, that is for a very late stage company which has a growth rate of maybe 5% or 10% kind of growth rate. You are an early stage company which will have a very significant higher growth rate. So let's say you have this 333x as the multiple for a late stage company. You can use a higher multiple for yourself, which is 1000x or 2000x, because you have a much higher growth rate. This is only if you are running a company in a very similar space, and there are established examples that have there are similar companies globally or in India, etc. So maybe you can work around if you want to work mathematically. This is one of the ways to work around mathematically. But ideally, generally, entrepreneurs always come up with like unique business models or proprietary. There's something new in it, which can never be compared with existing businesses or existing public companies. So it's very difficult to compare both the companies.
Right.
Thank you.
I'm afraid, guys, I know we started a few minutes late, beyond 11:30, but we've reached our allotted time, so we'll have to close here, Mahesh. And thank you so much for being so honest and candid. I know you're aware, you're usually very open about these things. It was really, really nice of you to be so honest about many of these, underlying internal processes, which are sometimes they seem a little opaque to startups which are at the early stages. Would you like to add something before we close?
Yeah, so thank you so much everyone for joining today, and thank you so much Mahesh for your insights and learning from the investment side and being the startup